My name is Franny Holford, and I'm the President and CEO of Life Sciences BC. Welcome to our hybrid, as you can maybe, it's good to see. Let's start with speaking series, going public, insights, methods, and preparedness in today's market. As we begin, I would like to acknowledge that we're joining this event on the ancestral, traditional, and unceded territory of the Coast Salish peoples, including the territories of the Musqueam, Squamish, and Salish First Nations. On with these lands, we are honored to live, work, and play. And as you can see out the window, they are truly beautiful, beautiful lands. For those of you that are not familiar with Life Sciences BC, we're a not-for-profit organization funded through membership and inventor contribution of our sponsors and partners. Our members are academic and research institutions, local and global companies working in digital health, medtech, biotech, therapeutics, and numerous organizations such as Place who have identified life sciences as a strategic vertical and provide services that support not only our members but also the ecosystem. At each event, we like to welcome our newest members. So here's a snapshot of them. We recently started a new membership category of individual members to really provide an opportunity for those individuals who either have are working in the sector or really want to get more closely connected into the sector. So those are our new members. Today's event is made possible by our longstanding sponsor, Blake's. The Blake's speaking series is one of our longest standing events, and we want to thank Joe, Wave Joe, who else I'm sure everybody knows you, for his leadership and commitment to bringing the sector together, showcasing innovation, supporting early stage companies, and their investment in LPP, which has been for decades, has been invaluable to our sector. I also want to thank Blake's for hosting us for the last 3 days to be running a BD and licensing masterclass. And particularly Laura over there, who has been welcoming us every day. I would say to her that I feel like they must feel like they're getting occupied by us. We've had 50 people here in this room doing a really deep dive intensive course in licensing and BD, and it's hugely successful. So thank you, Joe and Laura. I think you're going to miss us next week.
Please come back.
So we're delighted to be hosting this both online and in person. And I'm now going to pass it over to Joe to lead the event. Joe is a partner in the securities group at Blake's and helps run National Life Sciences Group. His practice focuses on corporate finance and mergers and acquisitions. He advises public and private companies, investment dealers, venture capital, private equity funds, and acts as an independent counsel to board of directors. Before his career in law, Joe worked in corporate finance with the National Investment Bank and in clinical research with a multinational pharmaceutical company. And you'd be hard pressed to find anyone who's not more passionate about life sciences in British Columbia. So thank you for your leadership, Joe, and I will now turn it over to you.
You have no mic, so thank you. Hopefully you can all hear me or the panelists up here. Just want to thank really quickly Life Sciences BC for everything they do on our behalf. It's a remarkable organization, and Wendy has taken it to new heights. So thank you for everything that you do for us, and also to the team for helping to put together events like this. It wouldn't happen without their hard work. We've been running this breakfast speaking series remarkably, it dates me, for over 25 years. And want to thank you also for joining us and continuing to be, members of our community and massive contributors to helping this community. With the advent of modern technology, it's really allowed us to expand the speakers that we can tap into to be international. We had one about 6 months ago with people joining from Europe, among other places. So it's quite incredible that we have this opportunity to have such a distinguished panel today. So I'm very pleased to be able to moderate it. I wouldn't be surprised if we canvass the panelists that we don't have 150 years of capital markets experience with this group. In a moment, I'm gonna ask the panelists to introduce themselves, but I think it's easy to say that they have very deep ties, all of them, to our life sciences community, both in BC and in Canada. Just really briefly, for example, David Soroya, who's with Jefferies. We've been involved with dozens and dozens of transactions with them, either where they represent their lead investment bank, or we have worked directly with them as well, dating back for me even before the Xenon IPO locally here, where they led that. Andy is an amazing executive with NASDAQ, and through many transactions, and the latest listing would be Eupraxia not that long ago. Deepa with Goodwin's is an amazing securities partner. Her together with Sam, they were instrumental in the Accelera IPO, and we worked with Goodwin's on numerous deals as a US firm to counterpart Canadian securities advice that we provide. Trin, I can't say enough about Trin. The volume of work that this gentleman is able to achieve, and the sleepless nights in getting through the IPO process was quite amazing. The company raised US $550 million on its IPO. It's the largest life sciences Canadian IPO, in Canadian history. In addition to that, it's just a testament to his ability to manage teams and teamwork. I think we started middle of September and closed December 15th, which was an incredibly close, short timeline considering the volume of work that needed to be achieved. I'll talk for a minute about complexity. And Kyle, a partner here in our securities group that I work very closely with on life sciences matters. And I think the latest one that we worked on going public was taking Engine, which didn't go directly in terms of an IPO, did a de-SPAC transaction, which led them and our ability to work with them last year to raise US $260 million. So that's a success story, and one that was largely managed out of this office, but their head office is in Quebec. So before I get to the introductions, I just want to frame today a little bit. We're not going to have a technical discussion. It's going to become apparent soon that the number of avenues to going public, there are many different paths a company can take, and they're highly technical, right? So it would take days to convey the information. So this is more about talking and giving you an update on where we are in the market, or what people are thinking about prospects going forward, at least in the near term. And then we can start to get on to some key issues to consider as you choose to prepare yourself if you wish to go public. What are some of the things to think about? Some technical issues, touching a little bit on some of the complexity on a cross-border basis in particular, which just adds a new dimension to it. So with that, feel free to ask questions along the way. We want this to be a dialogue. So whether it's between panelists going back and forth, it's not going to be PowerPoint presentation by individuals. So ask questions if you wish to. In terms of just quickly as an overview, many companies have the goal of becoming public, and there are obvious reasons for that. Some of the benefits include greater liquidity, access to public equity and debt, which in some cases can be done more efficiently or cost effectively. Increased credibility from both the disclosure regime and regulatory environment, and also equity as a currency for acquisitions. But nothing's free in life, so there are significant costs and administrative aspects to not only going through and becoming public, but also maintaining your listing and being a public company. And some of those include costs, both immediate and ongoing. And you can just imagine having the number of individuals involved that you'll need, the professionals, right? From legal, if it's cross-border Canadian and US, accounting, banking fees, exchange-related fees, D&O insurance, and the list goes on. Once you're public, there are going to be ongoing disclosure, governance, and other obligations to consider. So in terms of ramping up your team, that'll be necessary just based on the volume of work. You'll have increased exposure to lawsuits, particularly if you're listed in the US. It just is a fact of life that the US is more litigious than we typically are in Canada. You'll also be more vulnerable to hostile takeovers, and there are different mitigation strategies that are put in at the time of IPO, and we can talk about that a little if people want to. But one of the key aspects, at least from a US perspective, is staggered board, and it's not necessarily something accepted here with certain exchanges, but it is something that is one way to give a company an opportunity to get on its feet for some period of time and not be subject to those risks. You'll have timely and continuous reporting requirements, expanded corporate governance requirements, constraints on your flexibility to freely operate your company given the highly regulated environment. So taking a step back for a moment, the process I had mentioned for going public is very complex, and there are multiple avenues to getting there. And I'll just give you a really quick highlight, and we're not going to be able to go into every single one today. And we're happy to answer questions offline, or I'm sure there are articles that you can read. But in terms of thinking through a structure, you can just imagine. So from an IPO perspective, it could be Canadian only, it could be cross-border, or it could be US only. In Canada, you could also do a qualifying transaction of a CPC company or of a SPAC company. In the US, you can do a de-SPAC off of a SPAC, and Engine was an example that I raised a few minutes ago. And in Accelera's case, it was an IPO, but US only. And there are implications there on being a reporting issuer in Canada or being able to avoid that. And it's a very rare circumstance where you can avoid becoming a reporting issuer in Canada. There are direct listings, and that can be in Canada or the US or both. And that is if you're of sufficient status and you meet the listing requirements of whichever exchange you're looking to get on. Often there's a path forward through the filing of either a prospectus or registration statement to make that happen if you meet those requirements. There's also uplistings, and that can happen, you know, within Canada from one exchange to another, or you become listed on a US exchange if you're already listed in Canada, and there are different approaches on that as well. And if you are something called a foreign private issuer and are able to comply with the multi-jurisdictional disclosure system, you can file a shelf prospectus in Canada, MJDS shelf, corresponding F10 in the US, and rely on that to become listed you become a US registrant and then become listed on a US exchange. And that the SEC could choose to review, but generally doesn't. So that structure is brought together to allow companies to rely on Canadian securities laws principally, with certain overlay from US securities laws. And that becomes a very efficient and at times very attractive approach to have. So many companies will try and maintain their foreign private issuer status if they can. And then finally, and I'm sure there are other methods we haven't talked about, there's the reverse merger, reverse takeover situation. And you can imagine companies that, despite having amazing management teams and boards, there's significant risk in the business that they operate in, and you can have a failed clinical program And if you happen to have significant cash in the listing, there's an opportunity to then vend in another technology or opportunity. And a local example of a very well-run company is ESSA, who's currently, let's simply say, exploring strategic options available to it. So with that, I'm just going to briefly ask the panelists to introduce themselves, and then we'll get into it. And for the panelists, thank you very much for joining us today. And please, if you wish to contribute, hold your hand up or whatnot to a particular line of questioning. But once the introductions are done, I think we'll start by giving a bit of a market update and what we're seeing. And I'll turn first, please, to Andy and to David. So, like to introduce yourself?
Sure. Thank you, Joe, and thank you, Life Sciences BC. Trin Steinmark with AbCellera Biologics. I'm the company's global chief legal officer, compliance officer, corporate secretary, and privacy officer. It's a lot of titles. Probably know AbCellera if you're local here. We're very lean. We run very lean. It's been that way since inception. I joined AbCellera in 2019. With a plan that we would be going public last year. Everything changed, of course, in 2020 with COVID, and we made a rapid decision to go public in 2020. As Joe said, we got the green light from the board, and in about 3 months, we went from what are we going to do to listing on NASDAQ and being the largest IPO in biotech in Canada's history. Our market was, our raise was 555. And the reason we say 555 is because our first molecule that actually came out during COVID was our antibody 555. Internally, that was our number. Little inside secret there, but that's what we raised to sort of have symmetry with what we were doing. And then we had our first antibody, as you probably know, for COVID, followed by a second one. We continue to be lean. We are listed on NASDAQ. We have all of the we didn't do a list, but we can talk more a little about that later. But yeah, we're dealing with all of the things that Joe mentioned on a day-to-day basis of being a US traded company, the ups and downs with that, and being a BC Act corporation. So we have both Canadian and US side obligations on a daily basis, and dealing with we have offices in multiple jurisdictions. So we're not only dealing with Canada, we have US, we have Australia, and we have the UK. So we have a lot of things that we have to think about on a day-to-day basis.
Thank you.
Kyle Misewich, I'm a partner at Blake's here in Vancouver, practicing corporate and securities law, including public and private financings, M&A, general securities regulatory matters, and most of my work is focused in the life sciences technology spaces.
Thanks a lot. Andy, would you like to greet the crowd?
Yeah, good morning, everyone. Can you hear me okay?
Yes.
Good. Yeah, Andy Hall with NASDAQ. I've been with NASDAQ since 2004. I've been on the new listings team since 2007. And I work with companies that are looking to go public, but primarily companies that are already public, listed in Canada, wanting to add a US listing on NASDAQ, or transferring off of our competitor, or moving up from the over-the-counter. But it can speak to all aspects of companies becoming a new listing on NASDAQ. So thanks for your time.
Thanks, Andy. David?
Hi, everyone. My name is David Soria. I'm an investment banker at Jefferies. I'm based in New York and cover biotech companies, mainly in the US, but we also have a few clients in Canada, including Xenon that Joe mentioned. And, I think as a firm, we're pretty excited by the biotech community in BC, and we're also close to a few private that we hope one day will become public, maybe dual listed, maybe US IPOs. Glad to be participating in this panel. Thanks for Blake and Life Science BC to invite me here. We'll be chatting about the US IPO market, and hopefully I'll try to bring you some brighter perspective than what you may expect.
Thanks a lot, David. Deepa?
Can you hear me? All right, can everyone hear me?
Yes, perfect.
Perfect, thank you. Sorry about that. So I'm a life science lawyer, so I'm not really good at tech. So apologies for that. My name is Deepa Ridge. I'm a corporate partner at Goodwin. I'm in the life sciences practice. My practice is very similar to Joe and the Blake's team. We're life cycle, everything from the formation through to exits. We also have the pleasure of being Upseller as outside counsel, and so got to work with Blake's and Trin on their fabulous IPO during the pandemic, which was like landing a jumbo jet and turbulence, but it was a lot of fun. And I'm sure Trin will go into all the details of that. And so we represent a couple of companies in BC. I'm based in California, so we're up there quite a bit. And so I'd like to thank Blake's and Life Sciences BC for the opportunity to participate in this panel.
Fantastic. Thanks, Deepa. So first, Andy, I just want to say really appreciate your background. I agree we're all in this together. Your commentary there. It's been a really interesting short period of time. During our careers, we're very used to the cyclical nature of life sciences and the capital markets. They tend to be, I don't know, whatever you want to define it as, 3 to 5 year periods. And now it seems to be monthly. So I won't go back to when President Trump was first elected, but it seems since that time it was euphoric down. JP Morgan was confident. A lot of people were quite confident, I would say, or at least I left with a positive feeling. And lately a little bit less so, given the uncertainty and the volatility. So it's kind of hard to deal with that background when you're dealing also with a very complex business that you're in, right? And just in general dealing with the typical market backdrop. So would really be interested in views from David, you and Andy on kind of where we are, and ultimately I think maybe part of the theme is you can't always predict the future, but being prepared is going to be key, right? And choosing when the appropriate time to be prepared. But you can't have a window in 3 months and then start 2 months and 3 weeks later preparing, right? So maybe we'll turn to you guys for share with us where we are and where we're going potentially.
Yeah, that's right, Joe. I mean, I will tell you that the markets want to do well. We had a nice rally from November to the end of the year. What markets want is a friendly tax cuts and an easy regulatory environment, and that's what we were hoping we were getting. A little bit of volatility around January, but a very good February. I mean, the overall markets, the S&P was up over 5%, NASDAQ Composite over 6%, and the Dow 30 over 2%. But unfortunately, we've got a U.S. president that seems to be determined to have trade tensions with our closest neighbors and ally. And a trade war with these huge trading partners is only going to reduce GDP growth, increase inflation, and cause rates to stay where they are, maybe even increase, uncertainty in the market and volatility. So I think the market thought he was bluffing along the way and hopes that he still is. But we were predicting a sort of more normalized market, maybe 2018, 2019, not the gangbusters of 2020, 2021. And I think that can still happen. I think for Q2, we're seeing some companies looking to go out with caution. There's some very large companies that have filed and are looking at that Q2 timeframe. And then maybe even more optimistically for the latter part of the year to have more of a normalized market that we've seen maybe in 2019. But I'm sure, David, you have some additional comments.
Yeah, no, I agree. I think broadly with what you said, Andy. I think if we zoom in more on life science and biotech is like the lion's share of life science. I mean, this is like a high risk asset class, right? And as an high risk asset class, it is highly impacted by rates, which is the cost of money, the cost of capital, right? And rates, the expectations on cuts of rate have really slowed down. Right now, it's about 1 to 2 cuts later this year. So overall, that's not good for risky assets, whether it's biotech or even like tech has been hit pretty hard. General sentiment of uncertainty in terms of the policy of the new administration. The RFK nomination didn't help healthcare stocks benefit from the Trump rally. So there was a dislocation there, and there is still some uncertainty on the impact of his policies. Is government rationalization, headcount initiatives with Elon Musk? What is it going to mean for the FDA, for drug approval? Is it going to extend timeline? Potential around pricing, because that is consistent with populist policies, right? And so I think there's just an accumulation of risk and uncertainty that just makes this asset class underperform overall. Now, if you actually look at the performance of kind of biotech stock, I think year to date, it's kind of been neutral because I think a lot of the pain has been felt in December. And the other aspect is like the new issuance, right? The IPOs, which are obviously a very important indicator of the health of the market, right, have been pretty disappointing in terms of performance, right? So looking at biotech IPOs last year, you had about 17. This year, you had 4. Only 1 trade above IPO price of those 4 that launched this year, and then only 2 from last year, right? So basically, that means that most investors that invested in IPOs lost money, right? Which doesn't make a good case for new issuance. So overall, we have a challenging market, but there's no like real window that's open right now for IPOs, which doesn't mean that no companies will go. The most de-risk and highest quality profile will go, but we're not yet in a normalized environment where the average company can consider going public. Now, it doesn't mean don't get ready for it, because as we've seen last year, every quarter it's changed, right? The first quarter was very strong. The second quarter was terrible. And then the back to school season, like September, October, right before the election, also saw a lot of issuances. So the learning for private companies is to get ready for when it makes sense to go public from, a company-specific standpoint, right? Are you going to be de-risk enough? Are you going to have the profile and the capital that you need to go public and be attractive? And then target to be ready at that moment, which means, as Joe said, like you have to prepare well ahead of that, right? Get your financials ready, start your S1, etc. And then as soon as the window open, be ready to launch, because the window may be, a couple of weeks or months. So it's all about being ready.
Yeah, I've heard it equated at times to joining a line. Like, if you're in a position to go public, you're above average to excellent, and you join the line. If windows open up, let's say at the best opportunities, may be able to take advantage of it, but you want to be in line and have all your ducks in a row so that you're actually able to walk through the door if the opportunity arises. With that, if we could maybe just talk for a moment on whether to go public. Like, not every company can go public. I'm familiar right now with at least half a dozen that we're working with nationally to prepare. Not all of them would necessarily be able to go a traditional IPO route. Some may be, it may be an uplisting or direct listing on NASDAQ without a concurrent financing. There could be, a concurrent financing. Anyway, there are a lot of people that are planning, but all of those companies, there's something about it, right? They've got either right governance, right people, right technology, right place. They can meet the listing requirements. Any comments on preparedness, Deepak? and what companies should think about maybe 12 to 24 months out to be able to take advantage of a window if they can?
Sure. I think the way that, and I think David said it right, be ready so that when the window opens, however small it is, that you're ready to go out. So if you think there's going to be some sort of inflection point, and, with life science companies, it's always our data, right? So if we think there's some positive data that's coming, and we know that it's in the next, couple of months, 6, 7 months, whatever the time frame may be, or even a year out, whether we're private or public, we try to raise capital on the data, right? So we know data is coming. Let's try and get, whether it's a private round or a public round. And so if we're ready to do a public round, and we think this data is going to be positive, or we're gambling on, we're going to flip the cards in and see what happens. We always say, well, if you org up and, you can start the process, you can clear SEC comments, and you can wait. Right. And so then if the data and David, I'd be kind of interested in what you think as well. And so then if the data is public, then we flip up. But then, the data is good, then we flip public, right? Otherwise, we've cleared comments and we're waiting. So things that we need to get prepared for in advance would be financial statements, right? So what are the long poles in the tent? Get that going, start getting the PC EOB standards, start uplifting, start working with your accountants to get that going. We also like to ask people to start doing some corporate hygiene and cleanup. So start working with your counsel and start putting together a data room, for example, and start thinking about what that transaction would look like, because then you'll see things that you may need to clean up. Board governance would come to mind. You want to think about, you can't get the right directors at the last minute, and you need to start thinking about who's on your board and who you may still want to get on your board, whether you're going to remain public or whether you're going to remain private or you're going to go public. So things like that are, you can start doing some preparation beforehand. Start thinking about your story even before you go to bankers, because you need to know what your story is, and the banks will come in and help refine and sell that. But, we need to have a very strong corporate deck beforehand so that we, when you're assessing the banks as well, which bank actually understands and is resonating with your story. So David, I'd be kind of, interested in your perspective on getting ready. I mean, from a lawyer standpoint, for us, it's a lot of these, diligence, corporate, cleanup, getting your audited financials ready. And the way we'd like to think about it is get everything, because if the window does open, the window is likely to be small, and you want to be able to hit that.
Yeah, no, I completely agree. I think the only consideration is cost, right? It's like, do you want to incur cost now? Because if you're on file and you wait like 6 months or 9 months or 12 months, whatever, yeah, there may be some extra cost, but I think it's worth it because it gives you the optionality, which has like a lot of value, right? And as you said, I think a lot of the readiness work starts actually like without banker involvement. It's really with your auditor, with your corporate counsel, making sure that you're ready. You do some some housekeeping, and the bankers really get involved. Well, either to connect you with some investor when you're thinking of putting together the right syndicate for a crossover, but more so once you org up, it's just to put the first draft of the document of the prospectus into something that can be filed, and that's a process that takes 3 weeks at the quickest to like maybe a couple of months if things get slower, right? But that's not really the kind of the long pole in the tent, or that's not really what impact timeline. What impact timeline is your audits and is all the corporate hygiene that Deepa mentioned, which is why you need to start early.
Yeah, maybe I'll just jump in on the Canadian side. I think audited financial statements, that's an obvious one, and there are differences between Canada and the US too. And Deepa, you can keep me honest, but typically it's 2-year audit requirement in the US and 3 years in Canada. And so those conversations, getting them going early with Canadian legal counsel as well as US counsel to determine, do we need a 2-year audit or a 3-year audit, for instance. In terms of corporate cleanup, as Deepa mentioned. Do you need to collapse your share structure? What are the existing rights of your security holders? What are the terms of your material agreements in terms of consents and notice requirements? Do you need to hold a shareholders meeting? In some cases, you might need to conduct a plan of arrangement, which is a bit more involved. And so all those things, there's some lead time there. And David, to your point about, the cost and expense, sometimes you can, if you have to hold an annual general meeting anyways, annually, maybe there's an opportunity just to clean up your cap table with minimal expense in anticipation of doing an IPO, whether it's next year or the year beyond. And having that advanced planning can go a long way and without much expense.
Yeah, and just to add to that, that can be done, or some of the thinking in advance of engaging with underwriters or having an org meeting. So part of the structure or considerations are whether or not the company can even choose not to file a Canadian prospectus, right? To not become a reporting issuer. And if that were the case, and it's very rare, and Upseller was able to do that, then the requirement, the form that would be used is an S1, and you'd have 2 years requirement for audited. If it turns out for resale purposes that can't happen and a prospectus must be filed in Canada, then you've got 3 years, which then adds complexity. There are other considerations. Oftentimes companies want to look and feel as much like a US company as possible, and therefore will want to use US GAAP, right? And then that adds different complexity into it. With respect to that planning, Trin, you had a short amount of time to bring things together. I'm presuming teamwork is important, both internal and as between advisors and the banks and whatnot. There's a whole nuance there. It's not just about the work, it's having people that can work together to get it done.
Yeah, I think it's, Upseller is unique in several ways. We had just finished a B round. And while we were out on the B round doing a road show, we were asked all the time, why are you doing a B round? Why aren't you going public? You should be going public. And we weren't there. Just as a corporate culture, we weren't ready. The board, we have a great board, still have a great board. And we came back and as we started to see the markets, we got urged even stronger to decide to go public. And at that point, we had a very tight relationship with our directors who were very good with us, telling us why it was the right move. We were listening to the banks. We had some very good relationships across Canada as well as in the United States. And we really spent time thinking about, would this be the right time for the company? We knew that there was an election coming in the US, so we were concerned about what that might look like for us going forward. And then teamwork, both outside the company, but inside the company. We were small. When I joined, we were 65 people, and Andrew Booth and I, the CFO, and Carl Hansen, our CEO, the three of us are pretty much what did the IPO. And we had to be arm in arm, really committed to being able to do the IPO. In the world of COVID at the time, we had to do our road shows from our houses in different parts of the world. We couldn't get together. So we had to have a really strong team that could handle the pressure of doing all this work apart. I couldn't meet with my lawyers, Deepa and Joe. I couldn't meet with them personally. I had to do everything over the phone. Everything we did had to be in a very bizarre way of working. And it's a testament to having that team that's around you that is committed, that they each have their roles and responsibilities, and you can trust that they're going to get the job done. Because at 2 o'clock in the morning, when I'm on the phone with SEC counsel dealing with the stress issue, I need to know they're there, but I also need to know my team is there, ready to work. Because if that falls apart, it's going to make your life very difficult. So prep is critical, but the team is inside and out is fundamental. And if you're questioning your team at all, now is the time to make the changes. Don't do it in the middle of the IPO process because it'll disrupt you immensely.
Yeah, expertise is core to this. It's both the technical skills to do a cross-border deal. First of all, you want to work with people that have done cross-border, period, because it is different, right, than just doing domestic work. And having that level of expertise is just the cost of entry, right? Then all the soft skills come in, right? The ability to work in teams. Are you responsive? Are you creative? All those things. And in my entire career, I think the Upseller IPO was, at least for me, one of the best examples of teamwork I've ever seen. Like Deepa and the Goodwin team, we were on weekly, if not 3 times a week calls during that entire period. It was just one seamless team. It was just about the client, who's going to take this issue and deal with it, who's going to take that one. And there was no internal competitiveness for work. There was nothing. It was just, let's get this done in the best interests of Upsellera. And I was quite pleased at how it worked, and look forward to working with you, Deepa and Sam and others at Goodwin many times in the future. It was a great process from that perspective. So on to in terms of the markets right now, there is some general thinking, would it be, Andy, that, you know, towards maybe the summer, maybe the fall, like things will shake out a little bit over time? Because in past cycles, sometimes these events are a bit of noise, right? And you put your head down and you focus, and if you're doing all the right things, you end up coming out the right side of it at the end of the day. So it's not chasing the shiny baubles, right? It's about focus.
Yeah, I mean, we've had I'll just share my screen here. So this is the broad NASDAQ composite. I mean, it's still a strong performing market. This is the S&P 500, and then this is the NYSE composite. So, you know, even over the last 5 years, you've got a 21% annualized return. We've had the fall down here, but from a VIX perspective, we're at 24 right now, which is the volatility index of the S&P 500. In the teens is where you want to be. So the environment is there. It's conducive. As I said, the markets want to do well. It's just right now, you know, trade war is not going to do anyone any good. Canada, Mexico, or the US, if that can normalize and we can kind of go back to normalcy, I think we've got a good IPO market for the second half of the year.
That's fantastic.
Yeah.
Anything to add to that, or?
Sorry, what?
Sorry, anything
Was it
to add to that?
Yeah, so I would say it's impossible to predict, but I agree with Andy that it's a little bit unusual right now, because the volatility is quite low, and it's been actually quite low, and it's been like below 20 for a while. So yeah, there were some brief peaks above it, but you know, from that indicator's perspective, that should support like a healthy market for risky assets. I think it's just a lot of uncertainty, and a pretty hawkish tone on rates, and obviously the cost of capital is a key consideration here. When are we going to see some positive signal? I'm not expecting this at the end of the month, but we're expecting some improvement, whether it's before the summer or in September. I mean, there is no reason right now that it should not improve. Now, what we see with companies plan to go public is that there are like 3 on files, right, in life science right now, like 2 biotech, 1 medtech in the US. And it's still like pretty uncertain when they're going to launch. And there's a backlog of others that were supposed to go out kind of in March, early Q2, that postponed their plan to likely post-summer, right? So that means there is definitely a sentiment shared among a lot of private companies that were getting ready that, they should wait, and hopefully, the second half will look better. Now, as we said, we cannot just write off a potential strong market in mid or late Q2, because this is biotech. This is what happened last year. And again, just to the point of being prepared, if you think about the timing, at least in the US, I'm not sure if it's the same in Canada, but basically you flip public, and then you have a 2-week quiet period, and then that's when you can launch, right? So So basically, if you're ready from a filing perspective, you get some decent investor feedback during your testing the water. You have to kind of plan like 2-3 weeks ahead of launch in terms of the window to target. So we'll see. I mean, I think we're hopeful because it's also by the nature of this market, most of these companies need to raise money, right? And so whether it's public companies that need to raise or private companies that will need to go public at some point because they can't get like the same amount of capital privately, it will naturally happen. It may command a reset of valuations, which may not be a bad thing because that will help support performance in the market. So I think I would not recommend to get ready for next week or in 2 weeks from now, but I would expect things to improve in the relatively near term.
So
Thanks a
David
lot.
and Andy, what about when, in our sector in life sciences, let's say there are a lot of publics companies that are public now and they start coming out with good data, right? That could also kind of cause, a lot of desire to go public, right? For the privates, despite potentially what the macro markets are looking like.
So I mean, happy to take that first. It is and it's not because the fact that positive data gets rewarded and you see your share price increase, assuming you don't have too much of a financing overhang, meaning like people are not just anticipating you to like raise massively and therefore they just wait for you to raise instead of buying open market. This doesn't mean that the IPO class will do well. If you actually look at some of the big biotech companies that had positive data since the beginning of the year, I take one example like Akero, had some positive phase 2 data in the most serious indication for MASH. Their stock doubled, and they raised a lot of money at a very tight discount. So this is the sign of a well-functioning market. For IPOs, the issue is that if people anticipate that they're going to lose money because they think the stock is going to trade down after IPO, then there's no incentive for them to buy in the IPO, and they're just going to say, okay, well, I'll buy later, right, at a discount. And so I think what you need to see for IPO window to reopen is you need to see the recent IPOs trading above issue, right? And as I said before, only 3 IPOs out of like 21 are trading above issue since 2024, right? So this is like terrible performance, right? So until we see like some support above IPO price where people suddenly realize like, okay, well, I'm in the green. I'm not until we get there, I'm not expecting a lot more activity on the IPO front. Another thing that can help is obviously public M&A, right? And there hasn't been tons of it so far this year. If you look at the 3 deals that were announced, at the beginning of the JP Morgan conference, right? There were like 3 companies being taken out, 2 are private, and could have been IPO candidates potentially, right? And then 1 was public, and when you acquire a private company, the capital is returned to the LPs. When you acquire public companies, they have to reallocate it, into biotech stock, which is great because then that becomes like the currency for IPOs, et cetera. So we need a few things to work out, and it's not just good data from existing public companies.
Yeah, if you miss on your data, of course, there's going to be a downturn in the stock price, as David indicated, and we've had maybe a half a dozen of those that have gone public in 2024 that have missed on their trials, phase 2, first phase or third phase. But in terms of share my screen here, this looks at the IPO performance 30 days after on the corresponding years. We look really good for 2025. Metsera went public, I think around late January. They priced it 18. I think they're at 26 right now. Raised 316 million in a 2.7 billion market cap. So that's skewing the numbers here. yeah, they're absolutely, it's been challenging. This is healthcare in general, not just biotech, especially pharma, but this is how the performance looks. And then from a raise size, from an offering amount, you can kind of see the distribution here, most falling within the 100 to $250 million raise.
Yeah. And you know, one thing to note as well is that the bar, because of this changing IPO market, right, the bar to go public is quite high now. And you know, people or investors are really looking for safer bets. And what does it mean, right? It means it's science that is de-risked, right? So they don't want like novel mechanism of action, novel target, you know, too early in the clinical stage of development. They want like something that is de-risk. And the other thing is that they want to go after a large market opportunity, right? So not ultra rare type of indications. They're very tough on valuation, and so I mean, Metsera is kind of an odd one, but you know, it has a lot of specificities, a very strong investor syndicate, it's obesity, so not really applicable to most companies, but you should really think, especially when you raise privately, of like what is the reasonable valuation you can probably go out based on the profile you'll have when it's time to go out, and kind of work back from there. Okay, well, if I give a 20% step up at the IPO, which is what we've seen on average historically, like, you know, and I need to raise X amount of money, what it means for my for the valuation of this round, right? So I think it's very important to keep that in mind, because if you are, you know, if you're not realistic, then you'll have to do a down round before the IPO, right? Thinking of Artiva, which did that, for example. I think it's also, you definitely have, you know, more attention from investors if they see you as a potential, you know, strategic acquisition, right? If you're in an area that's pretty hot for big pharma, where you've had like a lot of M&A activity, that's definitely an important consideration. Investors also really care about being well capitalized, and the kind of rule of thumb is that you need to have at least 2 years of cash, you know, and to make sure you fund through like your key clinical milestones and read out. So I think we went from kind of like 1 year of cash to 2 years of cash at IPO, and that's definitely one to consider. So when you raise privately, raise as much as you can, because you know I never met people that regretted raising too much. And the last thing is make sure that you have a very strong investor syndicate that can support you in the IPO. And you know, if your investor syndicate is more VC style, make sure that the next round you also include some public investors. There's actually some pretty high correlation between like the amount of public investors in your crossover and how you perform at the IPO, because they'll be able to write the big check to make sure that, you know, the order book is pretty much covered when you go out, and they'll be able to support you going forward for the following financings, right? And then they won't get out of your stock. So you know, focusing on good public investors, long only, is also very important for a successful IPO.
Yeah, thanks. We touched briefly on counsel working closely together with management on the issuer side. That extends to counsel to the underwriters as well as accountants and auditors. But maybe for a moment, we can talk a little bit about the relationship between issuers, management, and investment banks, when to engage, relationship development over time. Andy, when should companies be calling you, right, to look at, you know, understanding how close they are or not to meeting, you know, minimum listing requirements, among other things? Like, is there red flags to raise, or like, is it investment banks chasing the issuers, or like presumably it goes both ways, right? It's relationship development, and also there are certain industries which are, the market is more receptive to at different times than others, and touch on going forward.
Yeah, in terms of engaging with NASDAQ as a private to public issuer, we like to have those conversations very early in the process. In terms of filing the application with NASDAQ, which is confidential, file that when you're ready to put in that first draft with the SEC. So if it's an F1, if you're going public as a foreign issuer, or you're doing I guess if you're you're already listed in Canada and you want to add the US listing and you qualify for the multi-jurisdictional filing status, you'd give us a draft of that F10 or the 40F. So since that's not reviewed, that's a quicker review process. But typically our process is about 6 weeks. It can extend longer to that. And we move in tandem with the SEC if they're reviewing that registration statement.
And I'll just quickly throw out that almost every transaction I've dealt with where there was a NASDAQ listing, the DTC process took far longer than anyone ever anticipated. So make a notation on that, right? Think about it early. David and Trin, in terms of relationship building with banks and engaging and timing and how to do that effectively, I would value any comments you have.
Yeah, so I would say it's never too early to build a relationship, but in the same time, where you will be able to leverage, the advice of a bank the most is when you're probably, 1 to 2 years from IPO. That's when you can start testing with them the story, your timeline of catalyst, your investor syndicate, your thoughts on how much capital you need, etc. In general, at least, at Jefferies, it's not advice, it's kind of free advice, right? So you should also take it. We don't help companies raise private rounds and get paid on it. We just connect the one we like with, investor that trust us, and that's why we can be very helpful. So I would say, yeah, kind of 1 to 2 years before IPO. I think if you're clinical stage, you can start having a discussion. And then in terms of us really rolling our sleeves to help you, that's kind of like when you hog up, and we'll help you like articulate the story in your prospectus, and then put you in front of the right investor, and get you, public.
Is it rare that you would assist with crossover rounds, or is that sometimes?
So I would say like we actually like to give our views and be helpful to the company by connecting them, but we're not working in the capacity of agent and not getting paid on it. Some banks do it. It's not really our business. And we tend to think that at least the US biotech companies, it kind of look weird if you have an advisor helping you. You should have already, via your existing investor base, via your relationship in previous companies, already like, some network that you can leverage. But obviously, if you need access to specific funds and bankers, don't be shy to ask them if they can connect you, right? I mean, it's you should be able to leverage the relationship with banks as much as you can. It's just like this is not really our business to like getting paid on those private rounds.
Yeah, I would echo that. I mean, we didn't have the luxury of 1 to 2 years of time to get comfortable with banks. We were doing a B round in 19, finished it in 20, and in that relationship building, we started to see some of the players. You're going to meet good banks, and you're going to meet really not good people when you go through the show with them. You just got to be prepared for it. You're going to come in, you're going to spend a lot of time. You're going to prepare these wonderful decks, and you're going to get a group of people in the room, and you're going to wonder if you got the same memo as to why you're in the room. It can be very frustrating because you're wasting a lot of your own time, and you only have so many slots you can fit in before you really start to think about who's your syndicate. And then when you actually start digging into who do you want to be on the cover, who do you want to be representing you in this process, you really have to have, I believe strongly, you have to have a great CEO who can sell the story. You really have to have someone who can get out there and really talk about why this is the place you should put your money. Your CFO, invaluable. You need someone who is not a bean counter. You need someone who is actually out there next to the CEO, walking the street, selling the company, talking about the money. I'll tout myself, you need a chief legal officer who can go in and talk to them as well, and understanding all the requirements they're gonna need and make on you. It is a tripartite team. And when you start putting your syndicate together, you want to understand maybe historical relationships between some of these banks. They don't always get along. That's the truth. There are banks that are very territorial about how they want and who they want on their syndicate if their lead left. And we had that experience. Our cover is different than what we thought it was going to be the minute we started. It changed midstream for some relationship issues. It was a hard decision, but we made the hard decision because it was the best thing for the company. There's one area that we haven't touched on, which is, assume you go IPO, what about after? How do you maintain the relationships afterwards? It doesn't end once you get the big checks. We're on the road all the time. My CFO, Andrew Booth, is always out at conferences. We're attending. We have an IR relationship all over the place. And it's really important because you think you have long holders in your stocks. You really don't. If the market turns, you'll start to see the filings and you'll wonder, wait, you were a long holder, now you're gone. And you really need to cultivate those relationships. And part of that is pre-IPO, but then it's post-IPO. Going to conferences, going to meetings, hosting investor days, whatever it might be. The relationship doesn't end. It's not a one-time shot, and you're making new relationships as you go, looking for new ones to invest in the company. And it really does require a teamwork of the CEO, the CFO. If you'd hire an IR team, your lawyers, really to be out there on a regular basis, talking about the company to keep the share price and the investment community interested in the company. Otherwise, the bottom can go out and you wonder what's happening. And if you ignore that, I think you'll be unhappy with where your stock performs at the end of the day.
Yeah, it's really important that not just from a governance perspective or meeting technical requirements, but that management has those core competencies. And it's not every day that a private company, that their management team has that ability to deal with public markets, which is a very different beast. It happened, I doubt it wasn't just fortuitous, it was through planning. Incredible team at Accelera who was able to bridge that and carry on and do very well. I note here in the audience, Pascal Deguise, our partner from Montreal. Maybe we'll pivot just for a second and talk about some of the different alternatives potentially and some factors to think about in going public, because not every company is capable necessarily of taking on that risk and cost, not with the uncertainty of coming out the other side with a financing. So in some cases, looking at other types of mechanisms to go public. So Kyle and Pascal were integral in helping us take enGene public. It was through a de-SPAC process. I understand it's no longer the flavor of the month. It did work for them. It was very highly complex. There were 4 tax jurisdictions. There was a complete reorg, financings in advance. It was about as complex as you're gonna get, and took a long period of time. It didn't have the luxury of getting done in 3 months. With that, any observations or whatnot, like that also involved close teamwork, but all of a sudden it was tax advisors in 4 jurisdictions and whatnot. It was just multiplication of the complexity.
Yeah, just an observation that it worked well for enGene, the de-SPAC transaction in their case. And what might work well for them might not work well for others. And so, and in that case, you're right, Joe. I mean, there's multiple jurisdictions, multiple lawyers in different jurisdictions dealing with those various issues, tax planning, you name it. But then you look at in the aftermath, I mean, they raised another couple $100 million in a US pipe 260 million, I think.
Yeah, two different pipes last year, 260. So it worked out quite well for them, and they're well financed into the future. So with that, any thoughts? Just I get it. It's not necessarily the most attractive vehicle, but in terms of, are some still happening? What are some considerations there? Is it worth talking about, or is it largely a dead avenue to going public?
Deals are still getting done. Surprisingly enough, there were 70 successful de-SPACs last year to NASDAQ, and there were 5 so far this year. Of course, many of the SPACs don't find a target and they time out. It's a short-term investment play for those investors that are in the SPACs. I would say in 2021, 60% of the IPOs were SPACs, and now it's more like a third. So they are still coming to market. I think we've had 16 so far this year of SPAC IPOs, but then finding that target and making it work on a de-SPAC basis is challenging. Obviously, you've got a lot of investors that don't have any sort of intention of holding that operating company, and they are going to redeem. So then as the management team, you're working hard to swap those investors out, or if there are investors there, having them hold and stay through the de-SPAC process, or doing a sizable PIPE transaction so you have capital at the end of the day. I've seen situations where there's a 99% redemption and the de-SPAC happens, and really what they got was the holding company. It was the PIPE that gave them the capital to be a public company on an ongoing basis. So they're still going public, but you really have to work hard, find the right partner for it to be a successful process.
Yeah, no, I agree. I think it's a misconception to think that SPACs are an easier way to go public than IPO. They're not. There are a few kind of life science focused SPACs that are looking for targets right now. But as far as I know, at least the higher quality ones haven't done anything in like almost a year now. And you know, as Andy said, it's like generally you can't count on the cash in the trust, right? So you have to basically do a PIPE, and to do a PIPE, it's pretty much the same as raising you know, an IPO, right? So you need to have a story that is resonating with investors, and you also need to have your audits done, and the timeline is actually not very different from the IPO. So it's generally not the base case for companies to go public. Now, it doesn't mean that you can't entertain it, because they may be a good match with one of the SPACs, and some SPACs tend to be a little bit more differentiated, where they try to minimize the redemption, right, by trying to get support from shareholders and having them vet you, etc. So it is an option. It's rarely plan A, but definitely something to consider.
Yeah, I agree. From what we see, it's not plan A, but not everyone necessarily has the luxury of plan A. Pivoting just for a moment to reverse mergers or RTOs. It's not necessarily the first route that people would take or companies would take, but there are occasions, and I can imagine at times, Andy, excellent companies, right? Good management teams. It's just the science didn't work out, right? And there's a pool of money, and sometimes it's quite challenging to quote unquote return the money to shareholders, right? Based on tax complexities and otherwise. So what are you guys seeing in terms of the market respect to shells and moving that forward, and any red herrings or concerns or things that you particularly look at, Andy, for example?
Yeah, it used to be a pretty vibrant market before the SPAC market in 2021. It kind of really took off. That would be a way a private company would go public. It needed the liquidity. It reversed into a shell or a limited operating entity, and then looked to list from there. Maybe they were traded on the over-the-counter, or they did a reverse merger into a TSXV company, and started out that way. It's drifted a little bit away from there just because the lure of the SPACs, right? There's this pot of gold with all this capital. Why not do the reverse into the SPAC? And hopefully all this capital is there for us. And then also we have a couple years ago, the exchanges in the US put forth this reverse merger seasoning rule. So if you do a reverse merger into an SEC filing company, whether it be a shell or a limited operating entity, then you need to season for a full year, put out a full 10K where the merger did not take place, be current with your filings, put out your quarterly filings if it's a US domiciled entity. The only way you could circumvent that, and this is more for smaller micro cap companies, is to do a $40 million firm commitment public offering. So then you could reverse into the SEC shell or limited operating entity, and then at any point do a $40 million raise and list on NASDAQ. A little bit of a loophole for the Canadian audience. You can do a reverse merger into a Canadian shell that's listed on the CSE or TSXV or what have you, and then uplist to NASDAQ without doing that seasoning or doing the offering because it's not an SEC registrant. It's filing in Canada, but it's not filing in the US. So you don't have to worry about the seasoning rule if it's a Canadian filing entity.
In terms of the market, David, is that a fairly de minimis part of the market in general for Avenue to go public, or?
Yeah, it's also not plan A. I think it has some, similarity to SPAC in terms of consideration. From a timeline perspective, it's not like really much faster than an IPO and probably longer. Depending on the cash at the public company you're reverse merging into, you may have to do a PIPE anyway. Your story needs to be ready for the public market in any case, right? So those are some of the similarities. I think some of the additional challenges are that you're really not controlling the process, and it's generally highly competitive, and it's kind of beauty pageant, where you're competing against another 50 private companies, and being moved, like if you're lucky, to the next round of due diligence, etc. So you're really not in control of your own destiny, versus in an IPO that's the case. The other thing is, often you see those public company that still think that they're worth something more than just the cash in the public shell. They want you to ascribe some value to some of their assets, right? And then it becomes like a relative valuation exercise that can be quite challenging. And then the final point, which is actually a very important one that people tend to forget, is that those public companies that have pretty high cash balance and are considered public shell candidates are definitely on the radar of some funds that are trying to buy their cash at a discount, right? And so we've seen that happening recently with Citius, right? Citius ended up being sold to one of those funds, right? And they had run a process to find a private partner, but ended up choosing that outcome. Accelerant, announced a deal with Alumis, and then in the middle of that, Concentra, which is a vehicle for an investor that's made its specialty of one of its specialty of buying the cash at a discount, made a competing offer, and that creates a real competition to those private companies, and a lot of investors are happy to get the cash back, right? So for all those considerations, it's not plan A, it's possible, and sometimes there's a good fit, and it's workable, but it has a lot of challenges too.
And it is very complex, and it involves a lot of advisors and many transaction committee meetings with bankers, so among other things. So just pivoting for a second, the audience here is mainly Canadian companies. Not every company has the ability to do what Accelerant did in terms of IPO at that kind of valuation, raising that amount of money. So in some cases, companies need to take it step by step. and as a consequence of requiring capital, listing in Canada first, which typically has a smaller pool, and associated with that will often be that listing. There'll be a Canadian prospectus offering with a concurrent US private placement. But as those companies grow, they will often look at the US listing to add that on. And in some cases, subsequent to that, when there's sufficient liquidity or market cap, choosing to perhaps delist from the Canadian exchange. Kyle, any thoughts on, we've done this a number of times in using an MJDS shelf as the basis to get the listing without a concurrent risk of financing, right? And then being in a position to do a financing quickly on a cross-border MJDS basis.
Yeah, it's a unique mechanism that some of our clients have used in the past, where they don't necessarily need financing. They're already listed in Canada. They don't necessarily need to do a big splash of US financing right away, but they're planning for it. They can control their own destiny, so to speak, become an SEC issuer, file on Canadian forms via the MJDS regime, and effectively be ready, get the listing on NASDAQ, and when market, when the demand's there, when the opportunity's there to then raise money. And so we've seen that, and it's just a nice way without kind of the risk of being dependent upon a concurrent financing of just, for nominal cost, getting that MJDS shelf up, for instance, completing your filings in the US, and being ready. For the end of the day, we're talking about Canadian issuers. Primarily, their operations are in Canada. Most of their assets are in Canada. If they are that foreign private issuer, and they're eligible, then it's a great mechanism to take advantage of.
Yeah, and I would argue that for companies, until at least they hit some certain minimum threshold, whether it's market cap or stage of development or however it's measured, having the dual listing can be advantageous, because this is a risky business, and if there's a setback in your clinical program, being able to retrench at times to the local market and perhaps raise smaller amounts, but have the ability to get through. A number of companies have been able to take advantage of that, and not having the Canadian listing can open up risk if you fall off the radar screen of US banks or interest of US investors for some period of time. Anyways, it's just something to weigh or consider.
Maybe the one thing I'll add, Joe, too, is that if there's the TSX interlisted issuer exemption too, as you're aware. And so even if most of your, if most of your trading volume is in the US, you may be eligible, if you're listed on the TSX, to rely on the interlisted issuer exemption. And it's just a way for the TSX to defer to NASDAQ rules in a lot of cases. And so at the end of the day, it's just a nice thing to keep in mind that you don't necessarily have to comply with both sets of regimes if you're doing a pricing and offering, if you're eligible under that.
Yeah, and depending on the circumstance, there's a lot of flexibility there, because Andy, there's a home jurisdiction rules on NASDAQ where you will defer at times to the rules in the Canadian jurisdiction, often in reliance on an opinion letter or letter from counsel. I don't know if you want to comment on that, because at times you may be able to work with the different exchanges to make it a transaction work.
Yeah, absolutely. If, for example, in Canada, you're only required to have 50% independence on the board, we're not going to impose our majority requirement. So you just get an opinion from counsel to get that exemption. But as we indicated, the MJDS system is fantastic. You have to have the 75 million in the market value of the public float US, but you can keep IFRS accounting, you can keep Canadian dollars, and it's just a wrap around the annual report that you do in CDAR. So whether it be an F10 that gives you the option to do the offering, or just use it as a registration, or the 40F, both of these documents, as we've indicated, are not typically reviewed by the SEC. So you create a draft, you put it to NASDAQ with your application, and then you file it. If it's not reviewed, it could go effective in less than a week. And you could either price the shelf the Canadian shelf that you've wrapped, or just register and list in the US. So then that over-the-counter security that typically trades in the US for almost every Canadian listed issue becomes a listed security on NASDAQ. And then it's very easy for you to maintain your foreign private issuer status. You'd have to fail both A and B. So going over 50% held by US investors and then failing one of these three items here, do you lose the foreign private issuer status? And then you have to start filing 10Ks and 10Qs with the US. But again, you don't have to use US GAAP, IFRS accounting, Canadian dollars. It's a wrap around a Canadian shell for the annual report that you do in Canada already. And then as you indicated, the US by far is the deepest pool of capital in the world. So this is looking at the total market capitalization of the world. 60% of it resides in the US. And for healthcare, biotech, this is where it is. There is some in Canada, but the majority is here. So if you do need to raise capital, this is where that capital exists compared to 2.5% in Canada. The US is 27% of the GDP, but 40% of the capitalization. And then lastly, to fill out these slides, this is data that we've looked at companies that were Canadian listed, had this kind of funky over-the-counter trading with an F symbol, and then became a listed security in the volume in the US, going from an unlisted stock to a listed stock, how that increased. The Canadian volume increased as well, so it wasn't a cannibalization, but the most apparent is the growth in the institutional holders. Becoming US listed, institutions have you on their radar screen, and they start to take a position in the stock, and then usually adding maybe 2 or more sell side analysts. And the pool of data here is from like the mid 90s to just current. And a lot of these companies are falling probably in around the 200 million market cap range, because there are some large companies in Canada, the majority fall within the small to micro cap space. So this is kind of the benefits of adding the US listing. Of course, the cost would be the increased D&O insurance and other items.
Yeah, and on the D&O front, that has come down recently. It was exorbitant a couple of years ago. So we only have a few minutes left, and as we wrap up, like, it's an incredible pool of talent on this panel. So I'm sure they would be open to answering questions or whatnot after or in the room here or subsequently. But given the topics raised today, any final comments from panel members? And then to the extent anyone has questions, let us know. Oh, I'm sorry.
Yeah, Wolfgang Europe, I'm with Chrysalix, so on a long-term VC. You've talked primarily about what I would call the mechanical part of going public. Can we spend a little bit on the business part? And when you sit on a board of a company like Apcellera, and there are many of those, very often leading up to this process, there is an intense discussion on, should we go public? Can we get enough money? Because we almost need to have assurance that we have enough money for a long time until we become very, very stable cash flow positive. And the discussion then is also, how can we ensure that we create the right story for it? And how can we ensure that enough analysts buy into this? And that is the main struggle that boards have at that time. And I would love to get your perspective on that a little bit further.
Yeah, that's a little bit less than for council, that question, and we'll turn it over in a second. But look, that's the art of it, okay? Like, this isn't science. Like, we're not going to do a calculation and you're going to know exactly, okay, we go today or whatnot, right? So even at the best of times in the market, there's no guarantee you're going to come out the other side, or there isn't some adverse event that happens in the business that was unexpected or whatnot. So that entire calculus is exceptionally important, right? And then it becomes a risk adjusted decision, right? Based on what your alternatives and options are, and whether, you know, it's worth the risk to go a traditional IPO. Some people may go a different route because they can do a pipe in advance or whatever and de-risk it a little bit along those lines. But in terms of the story, that's over to Trin and maybe David, like a colossal amount of time gets put into the prospectus on the business section, right? And telling that story in a compelling way that the investors will accept and deliver the valuation that the board is hoping for. Like, do you guys want to comment on that?
Yeah, I mean,
Yeah.
from Accelera, it was interesting because as I mentioned, we were doing a B round. So we already had the advantage of having a lot of material. Now, one thing about Accelera, we're not the business model we were when we went IPO. We're very different now. We were a partnership developing antibodies for others model. Now we're a preclinical stage company with 2 assets going to the clinic next quarter, or in a couple months actually. So we actually did a very different business model. We pivoted after we became public to a completely different type of entity. And the market has kept us basically where we were, didn't do really anything. But your question is very good because the board is, you really want a good makeup on your board. And it's very difficult. When we were going public, we had a VC was on our board. We had other people on our board, and we had to decide what was our board going to look like once we went public. Of course, we had a very well-known investor in the community, Peter Thiel, who joined our board. Very strong guidance for us. But where it really, I think, starts with is the relationship with your CEO and your board, and making sure that you've got the right CEO who really can get out there and talk about the technology, talk about where this company is going. Everybody says they can do it. Every CEO will say they can do it, but to be honest, they can't. It is a skill, it is an art, and they have to have the gravitas to be able to stand up there and really get out there and take risks. And I can't understate the value of having the team around the CEO who can sell the story. And the directors really have to be committed to going public. It's a very risky time when you're saying this because they're doing exactly what you said. You know, are you going to do this? How is it going to go? We were having meetings with our board weekly, constantly talking to them about how the syndicate was coming together. But we also had a very hands-off board at the same time. They were letting us run the show. They wanted us to do this because they trusted us. So it takes time to evolve to a company that can have a board that trusts the CEO and really gives that power over to the company. But on the flip side, one more time, it's very important that as the company, you keep your board where they're supposed to be. It's your company. You have to run your company, and you have to have that balance of getting trust and faith in them, but you also have to say what we're doing is our company. And if the directors can't let you do that, you have to reevaluate who's on your board.
Just in conclusion, David, do you want to round that out? Because some of that interaction between management and the board is predicated on information it's getting not only directly from investors, but from the investment bank on where the risks are. Is it likely to conclude in a positive result, et cetera? Like there's a close working relationship with the bank.
Yeah, no, agreed. And I think there were a few pieces of questions, right, from the audience, right? So one was around research, right? It's like, how do you make sure you have the right research analysts covering you? Well, it really starts with your syndicate, your IPO syndicate, right? So one of the key considerations, especially for the banks that are not the lead banks, right? If you think about the lead bank as kind of the one responsible for executing the IPO, you want someone who was very strong from an ECM perspective, knows investors, has good access, understand how to allocate, understand, how to price, etc. Right? The other banks in the syndicate, research is a key consideration, right? And you have to build your syndicate with that into consideration, where you need to have, the research analyst that knows the space, understand your story, that investors listen to, and that are going to pitch the story to investors as well, right? So this is really key, and this starts when you form your syndicate, and then as you become a public company, you'll have the opportunity to get some research from additional banks. Generally, when you get them involved, somehow, because at the end of the day, research is still a cost, right, for investment banks. On the question around like how much capital do I need? I think I've never heard a client say I raise too much. So I think as a private company, you need to make sure that you can survive as a private company, and that you always need to think about what gets you, way beyond your next inflection point that you can use to raise privately or to raise publicly or potentially to be acquired, right? And I mentioned a rule of thumb that we see now for IPOs is that you need to have at least 2 years of cash. Now, what is more relevant is when is kind of the next time you can finance the company, right? Most biotech company will need to go back to the market to raise quite a few times before they become profitable. And so you need to have a very clear idea of, what does the timeline look like in terms of value inflection point that you can use to raise, and make sure you have a pretty big, safety cushion beyond that, right? So to take an example, you go public, you want to have kind of your next value inflection point, no more than 12 months away, because otherwise investors are going to kind of, lose interest and say, well, I'll come back closer to your value inflection point, right? And let's say this value inflection point is 9 months from the IPO. Well, you want to make sure you have cash, not just, to 9 months, but at least through like a year and 9 months and probably over 2 years, right? Because this way, depending on the outcome of that value inflection point, if it's positive, you don't have an absolute need to finance. And so that means you're not going to have, a massive financing overhang that's going to wait on your stock. And if it's negative, then you still have some capital that you can use either to fund a second program or, to revisit how you're going to develop that asset. So again, I think making sure you're well capitalized and that you have a good timeline of value inflection point at IPO to make sure you keep investor focused and engaged.
Thank you very much, David. So to the entire panel, thank you very much. This has been a brilliant session, so thanks for making time. Also to all the participants here today in person and virtually online, thank you for joining us. I think, Wendy, do you have a few wrap-up words or Ryan? That would be great.
Quick question.
Oh, please.
To Andy.
Oh.
How many companies do you know that have at least 50 million in the bank but trading below market cap?
Yeah, I mean, I know a year ago when I looked at the data, there was a pretty high percentage that they were trading at their market cap was at a discount to cash. I don't know what the numbers are now.
I had some data actually on that. It's a little depressing, but since you ask, so again, in the US, there's about like 600 biotech companies that are publicly listed, right? 24% have negative enterprise value, meaning the market cap trades below cash, right? And another 30% have an enterprise value that's positive but less than $100 million, right? So between those two buckets, you basically have like more than half, so 55% of biotech that have a value less than $100 million on an enterprise value basis. What it means as a private company in terms of valuation is that you're competing against that, right? And that's why we're seeing a lot of pressure on private financing, because like, how are you going to justify a pre-money of like $300 or $400 million, on a financing round that's private, when like you're not much more advanced than a company that trades at like $50 million enterprise value, where the investor has liquidity because it's public, there's more transparency, etc. Right? So that's a very important thing to consider when you discuss valuation, is having that in mind, and hopefully you deserve a very rich valuation, but also keep in mind what the public market is kind of setting as a benchmark.
Thank you. Sorry, are there wrap-up comments?
Great to just like to thank everyone, our speakers today. David Soria and Paul Linsvich, Deepak Ridge, Trin Simon, and of course my moderator, Garcia. Thank you to our sponsor, Blake's. Thank you to our LSC events team, the Gold Card, manager events, and our co-op specialist. Just letting you know, we have a couple of upcoming events that you'll see here. We're working on our Road to Web Summit, so keep a look at that. We're going to be in Vancouver Island the first week of April 2nd. Letting you may have seen some information about our Life Sciences Road Catalyst project. So the deadline for that is today. To register to learn more about our upcoming events and programs, please visit the Life Sciences BC website. And just lastly, just wanted to let you know we've got Web Summit is coming to Vancouver May 27th to 30th. And as we wrap up, I'd like to thank all our annual sponsors. We're grateful for your continued contributions to the system. And with that, I hope you enjoy the rest of your day and look forward to seeing you all soon. Enjoy the sunny day. Thanks, everyone.
Thanks.
Thanks, everyone.
Thank you.
Everyone.